A bank can look solid for decades and die in a single week, not because the world suddenly went crazy, but because its fragility was already there, hidden under years of calm. That was the uncomfortable lesson from Silicon Valley Bank. For a long time, it looked like a specialized, sophisticated institution, deeply connected to startups, venture capital, and technology companies. But underneath, there was a dangerous combination: concentrated deposits, assets sensitive to interest rates, customers highly connected to each other, and a structure that depended too much on nobody panicking at the same time. While the environment was calm, everything looked efficient. When the regime changed, that efficiency became fragility. That is the point of Antifragile. Chaos does not create fragility, it reveals it. And the question that structures this video is simple. If something happens that you did not predict, does your business, your portfolio, or your career break, stay the same, or become stronger? Most people try to avoid chaos. The best systems are designed to benefit from it. This video is not a summary of the book. It is a decision system. In the next few minutes, you will see 3 playbooks. First, how to detect if your system is fragile. Second, how to build optionality so you can benefit from disorder. Third, how to use the barbell strategy to limit downside and keep upside open. This is not about guessing the next crisis. It is about not needing to guess it. There are 3 ways to face disorder. The fragile loses more than it gains when volatility rises. The robust absorbs the shock and returns to the same place. The antifragile improves because of the shock. A glass cup is fragile. A block of steel is robust. A system that learns, adapts, and gains capacity after stress is antifragile. Most companies, portfolios, and careers are not as solid as they look. They simply have not been tested by the right kind of shock. In calm times, fragility disguises itself as efficiency. Less inventory, less liquidity, less redundancy, more debt, more concentration, more dependence on one client, one income source, one platform, or one thesis. All of that looks brilliant when nothing fails. But when something fails, you discover that you did not have efficiency. You had zero margin for error. And in an uncertain world, zero margin for error is invisible debt. Playbook 1. Detect fragility. The question is not what crisis is coming. The question is what part of your system dies if the world stops being calm. That difference matters. The naive operator tries to predict the shock. The serious operator looks for the shock that would already kill him. Fragility usually hides in 4 places. First, liquidity. How long can you survive if cash flow stops, customers delay payments, deposits leave, or the market freezes? Second, concentration. How dependent are you on one customer, one supplier, one platform, one person, one thesis, or one source of capital? Third, maturity mismatch. How much do you depend on funding short-term obligations with long-term assets, future promises, or income that has not arrived yet? Fourth, extreme efficiency. How much have you removed buffers, inventory, redundancy, or room to maneuver just to look more profitable in normal times? Silicon Valley Bank is useful because it was not destroyed by an impossible-to-imagine event. It was destroyed by a combination of fragilities that became visible at the same time. Interest rates rose. The value of certain assets fell. Customers needed liquidity. Confidence broke. And when everyone looked at the exit at the same time, the structure could not hold. The lesson is not that all banks are fragile. The lesson is more precise. If your liquidity depends on nobody getting scared, you do not have real liquidity. You have borrowed confidence. Now compare that with Toyota after Fukushima. Many companies learned too late that a supply chain that is too efficient can become dangerous when it has no redundancy. After suffering major shocks in its supply chain, Toyota worked to map critical suppliers, create more visibility, and reinforce certain buffers. That does not always look efficient on a normal spreadsheet. But when a shock arrives, that redundancy can save the system. This is the common mistake, confusing efficiency with safety. A company can be efficient and fragile at the same time. A portfolio can be optimized and vulnerable. A career can look focused and depend on a single door. Practical action. Run a fragility audit with 4 questions. 1. What happens if my main income source stops for 90 days? 2. What happens if my most important asset falls 50%? 3. What happens if my key supplier, platform, or customer disappears? 4. What decision would be very hard to reverse if I am wrong? If just one answer leaves you without oxygen, that is your fragility. You do not need to know when the shock will arrive. You already know where it will hurt. Playbook 2. Build optionality. An option is a bet where the loss is limited and the upside can be large. It is not about betting harder. It is about designing exposure better. Most people think that benefiting from chaos means taking more risk. No. Often, it means the opposite. You have to take small, reversible, cheap risks so that error does not kill you and learning accumulates. Real optionality has 4 conditions. The maximum loss is defined. Learning is mandatory. There is a possibility to scale if it works, and you can exit quickly if it does not. Without those 4, you do not have an option. You have a bet with good marketing. Netflix gives a useful example with Chaos Monkey. The idea was to introduce controlled failures into the infrastructure to discover weaknesses before they turned into major failures. That is anti-fragile thinking. Do not wait for the system to fail in production. Make it fail in small ways so you can learn before the big accident. The system does not become anti-fragile because it avoids mistakes. It becomes anti-fragile because it turns small mistakes into information. Moderna shows another form of optionality. It was not just a company betting on one isolated product. It was building a technology platform that could be applied to multiple areas. When a massive shock arrived, that accumulated optionality made it possible to move fast. The lesson is not to copy Moderna. The lesson is to understand the architecture. A company with one binary bet is fragile. A company with a platform that allows many experiments has more options. In your professional life, the same logic applies. One income source is fragile. A skill that only works in one industry is fragile. A network that depends on one person is fragile. But a portfolio of skills, relationships, and small experiments creates optionality. The common mistake is thinking that optionality means dispersion. It does not. Dispersion is doing many things without logic. Optionality is creating many small doors toward large outcomes. Practical action. Design 3 low-cost experiments. 1 for your business, 1 for your money, 1 for your career. Each experiment must answer this. How much can I lose? What will I learn? What would have to happen for me to scale it? And when do I shut it down if it does not work? If you cannot answer those 4 questions, it is not optionality. It is noise. The audit question is simple. If this bet fails, does it leave me with information or does it leave me on the floor? If it leaves you on the floor, it is not an experiment. It is roulette. Playbook 3. Use the barbell strategy. The barbell separates 2 things most people mix badly: survival and upside. On one end, you have radical safety, liquidity, low debt, protected resources, room to maneuver, and assets that do not force you to sell at the worst possible moment. On the other end, you have convex bets, experiments, options, investments, or projects where you can lose little and win a lot. What you remove is the fake middle, that gray zone of moderate risk that does not truly protect you, but also does not have extraordinary upside. Many people think the barbell is conservative. It is not. It is aggressive, but in an intelligent way. It protects the base so you can attack when opportunity appears. Berkshire Hathaway in 2008 is a strong example. While many were forced to sell, Buffett had liquidity, patience, and reputation. That allowed him to negotiate from strength when others were negotiating from necessity. The lesson is not that everyone should copy Berkshire. The lesson is that the person who is not forced to sell during a crisis can buy options that others cannot touch. Liquidity is not dead money if it gives you the ability to act when everyone else loses the ability to act. In trading, this looks like separating survival capital from opportunity capital. You cannot have your entire account exposed to one thesis that erases you if it fails. You need a base that does not get destroyed and a part prepared to capture convexity. In business, it means not optimizing everything for this quarter's margin if that removes your ability to survive the next shock. In a career, it means not depending on one income source, one skill, or one boss. The common mistake is filling the middle with things that look prudent but hide fragility. Diversification that does not diversify. Debt that looks manageable until rates rise. Complexity that looks like sophistication until you need to act fast. Practical action. Draw your barbell. On the left side, write which resources are protected against ruin. Liquidity, time, health, relationships, capital, reputation. On the right side, write your convex bets. Projects, investments, skills, content, relationships, or experiments with large upside. Then, look at the center and ask, what do I have here that neither protects me nor multiplies me? That gets eliminated, reduced, or redesigned. The audit question is this: what part of my resources is protected against ruin, and what part can multiply without destroying me if it fails? Now bring the three playbooks together. First, detect what breaks you. Second, design cheap errors. Third, protect the base and open the upside. That is the system. Do not ask what will happen. Ask what happens to you if something occurs that you did not see coming. That question changes everything. Because the problem for many people is not that they cannot predict the future. The problem is that they build systems that only work if the future behaves well. A company that needs perfect growth, cheap credit, and patient customers to survive is not strong. A portfolio that needs permanently low volatility is not strong. A career that depends on one income source, one platform, or one professional identity is not strong. All of that can work for years. But working is not the same as being anti-fragile. Sometimes it just means the right shock has not arrived yet. The immediate action is a 10-minute audit. Open a sheet and write 3 columns. First column, what can break me? Second column, what can I test cheaply? Third column, what resources are protected against ruin? In the first column, write your real fragilities: debt, concentration, dependence, lack of liquidity, critical relationships, key customers, platforms, health, time, or reputation. In the second column, write 3 small experiments you can run without destroying yourself if they fail. A new channel, a new skill, a commercial test, a small investment thesis, a minimum product, a strategic conversation. In the third column, write what is protected: cash, time, reputation, energy, relationships, capital. If the third column is empty, you do not have a barbell. You have hope with Excel, and Excel will not save you when the world changes. The only thing you need to remember is this: the goal is not to predict chaos. It is to design so chaos works in your favor. I want to read real cases. Where are you betting your whole system on the world staying calm? Write it in this format: business, portfolio, or career, main fragility, option you could build, and what you should eliminate. At Playbooks de Caja, we do not summarize books. We turn ideas into decision systems. See you in the next playbook.